Hey, good morning, everyone. Marty Mazzori here. It is Friday, the 25th of April, 2025, with your end of week market and economic snapshot. We're going to keep it fairly brief on the economy. I haven't yet scored our index, which I do each week personally, but it's going to stay relatively weak. Last week, we were a negative 14. Just knowing the data that's been coming out, and I do want to share one data point with you that came out this morning. It's probably going to stay the same, maybe deteriorate just a little bit. If anything's dramatic, then I'll circle back before next week's scoring with the detail. So let's just get to that. So the one data point that came out this morning that I wanted to share was the University of Michigan's Consumer Sentiment Survey. And it is just continuing to plummet. We've got folks feeling very not good about their current and go-forward circumstances. And in this survey, on top of that, they're feeling particularly not good about the prospects for inflation over the next 6 to 12 months either. So consumers aren't feeling it. And as I'm going to share here in a moment, we're beginning to see more and more concerns coming out of not all, but enough of the earnings statements to be concerned about. In fact, it makes sense, again, relative to what we're seeing in the data and so on. But before we get to that, let's just talk for a second about where the market is. Right now, stocks are struggling their way, kind of eking their way back into the green. The Dow is down 90 points or so, was down 200 or 300 a little bit earlier. The S&P has been flirting with positive territory most of the day, but it's kind of like what I shared on the written blog here a day or so ago, and that is just the breadth. Like, for example, the S&P is up 0.33% as I speak, although the breadth, the advancers relative to decliners, is pretty negative, as you can see right here. Of the S&P 500, or 503 actually, 330 are actually in the red. The NASDAQ index, the NASDAQ composite index, is also in the green, but as you can see, significantly more of the stocks in that particular index are actually in the red. The Dow, as you can see, is getting pretty close to flat, down 73 points now, but 18 of the 30 are actually in the red. And when we look at it sector by sector, you can see that it's all about what have been really beaten up a ton, down, well into double digits, or consumer discretionary. Information technology, communication services are up today as well. Real estate has just moved into the green. Industrials are perfectly flat. And then, of course, healthcare, energy, utilities, financials, and consumer staples, which have been really good performers this year. We've been seeing rotation out of that the past week or so into the things that have been markedly beaten up. And materials, interestingly, are down a full 1% today. So again, we can feel good about the market being in the green. It's been a very good week overall, but it hasn't been a really good week for breadths. Lots and lots of uncertainty, of course, in the headlines, but also, despite the nice move this week, also in the market internals, at least for more than a day or so during the past week. So with regard to the uncertainty around tariffs, the market actually opened a little bit in the green today, then it promptly fell into the red, although it's recovering, as I mentioned, on details coming out of President Trump's Time magazine interview. He basically tells Time that he's convinced that tariffs are necessary. He said the bond market was getting the yips when he backed off just a few hours after implementing those reciprocal tariffs, but I wasn't. Again, the bond market was getting the yips, but I wasn't. I think he was convinced by at least a couple of his advisors that Treasury bonds were in some serious risk. They were showing some real fragility. I think we've talked about the basis trade that hedge funds are engaged in. There's like $1 trillion tied up in there, and if it goes the wrong way on them, we can see some dramatic, kind of scary things begin to happen. It could make it look like credit markets are cracking, And they essentially would be, but make no mistake, the Fed will intervene with all barrels blazing if indeed something did get systemic there. He says he would consider a total victory if the U.S. still has as high as 50% on foreign imports a year from now. Folks, I can sell you with a high, exceptionally high, a 100% degree of confidence that if we had that, we will have a recession to go with it. So do not expect to see 50% tariffs on all foreign imports a year from now. Then I think I'll just stop there. Much more to come, and it seems to be changing by the day, if not by the minute. Okay, and as you can see here, the market breadth has deteriorated a bit since I've been talking. The S&P is still about 38 basis points, 0.38% in the green. The Dow is still down about 100 points, yada, yada. It's just that the sectors have been deteriorating. So all of the gains today are concentrated in just three sectors, not the hallmark of a healthy market. But, one day or 2 days or even a week does not a trend make. So we still have our overall concerns that have to do with really more the data and the long-term implications of what's going on these days. So with regard to what corporate America is telling us, so the tech sector actually is sounding a pretty rosy tune. Google said they're not going to be cutting back on any data center build-outs. They continue to see double-digit earnings growth. YouTube, which they own, saw good performance, 10% growth in advertising revenues. And again, with respect to CapEx, they spent $17 billion in the first quarter, reflecting investment, quote, in our technical infrastructure, with the largest component being investment in services, followed by data centers to support the growth of our business across Google Services, Google Cloud, and Google DeepMind. So then we move on from tech talk and get to the real economy, or get to real world talk, if you will. Procter & Gamble, and this probably speaks somewhat to the pain that we're seeing of late in staples, and I do think a lot of that is rotation. But from Procter & Gamble, third quarter results on both top and bottom lines were heavily impacted by consumer and retailer volatility during the quarter, primarily in the U.S. and in Europe. The consumer has been hit with a lot of volatility, market volatility that impacts their portfolios, their 401ks, volatility in the economic outlook, uncertainty on the job market, volatility in terms of mortgage rate expectations, all the divisiveness and nationalist rhetoric that we saw around the world, uncertainty on tariffs, the impact on prices and availability of goods. So the consumer has been hit with a lot, and that's a lot to process. I think I can just stop there. I've got Pepsi, Tractor Supply, Hasbro toys lined up here, and essentially, folks, that's the message. Consumers are concerned, and it's beginning to show up in their spending activity. And that's the sort of thing that you think about when you think about odds of recession going forward in a consumption-driven economy like ours. So I will keep you posted and continue to comment more often than normal as this volatility continues. Okay, so let's just get quickly to the markets. Interesting dynamics. Here's that daily S&P 500 chart that we work from. And, we have that downtrend line. And I think I mentioned this yesterday or the day before that we've got some double resistance right here. We have the trend line and we have that 50% retracement, right? Call it 5,500 on the S&P. And it's at 5507 and seems to be kind of stuck right there. I could definitely see it, breaking above this, certainly with a little more good news. The technicals right here in terms of just this resistance says that odds favor, the market selling off a bit. However, the momentum looks pretty solid right here, at least relative to what's been going on right here at that 50% retracement. So we'll see how that plays out. Okay, so the dollar bouncing around in here, it's beginning to show some life. Of course, if it were to break back below, we'd have that bear flag pattern that you're used to seeing me draw for you, and that would be very bearish, the dollar. And in terms of yields, Again, just the 10-year right around this 4.25 rate, coming down a bit today. Yeah, so we're making money on our long-term Treasury ETF today. So that's not a bad sign that at least the world is buying treasuries. It's not a good sign in terms of what it may say about the economy going forward, but this has been a mixed up scenario as I've been reporting to you of late. There's been stress in the treasury market. There's a lot of leverage that hedge funds are using to manipulate the spread they can get between the cash and the futures market. And if they get too far on one side, that can be messy. That had something to do, I think, with the president quickly changing the scope of those reciprocal tariffs here a week or so ago. And, there is still speculation that some actors on the global scene may be selling treasuries. It's not necessarily showing up in the auctions that way. We talked about that as well, and I'm sure we'll talk about it more going forward. Gold, we did have this. Still looks like a blow-off top to me. Big down day. Another one. We were down about 4%. Nice rally yesterday, but we're going right back to that support line right here today. Gold is down about 1.75%. My best guess in the short term is that gold sees significantly more correction than we've seen so far. Long term, as I have to say every time I talk about gold, we are very bullish, I think, for all the obvious reasons. But these kinds of parabolic moves just don't get to last, and typically they have to be corrected, and they almost always are. So I could probably stop there. I do have some other charts up, but this was just for my own use. Looking at this is a natural gas ETF. We own Range Resources. That's our natural gas play. It's actually up 2% today. And without going into the weeds, this chart is telling me, the short-term chart, that we may get a rally in natural gas going forward. But anyway, that's just getting more into the weeds. But we do look at each of our positions in each of our sectors. One at a time. We have literally a thesis behind every single position we own, and then we have to meld it together with our overall view of the world and managing our portfolio to what we think makes the most sense from the global, risk-reward setup. And so that keeps us pretty moderate to conservative right now, continues to have us hedging. And so far we're having a good year, certainly relative to what the U.S. stock market is doing. But we take absolutely nothing for granted, I assure you. So I'll leave it there. Hope you all have the best of weekends, and I'll be back very soon. Take care. Bye-bye.